Global markets were thrown into turmoil on Thursday as the outbreak of a war on European soil sent prices of commodities from oil and gas to wheat surging while stock markets plunged. The current tension between Russia and Ukraine has sent shivers across global markets, reminding them of 2008's global economic meltdown. Apart from the oil market, other markets like the fixed income and the commodities markets are primed for an upward spiral as investors take a flight to safety and go long in commodity futures. Since the beginning of last week, the commodities market has seen prices rise as investors pivot towards safer assets such as gold and silver, while palladium, corn, and wheat have all traded higher. From Europe to Asia to Africa, the tension triggered by the conflict picked as President Vladimir Putin called the bluff of his critics and other global leaders and declared a full-scale military operations in Ukraine. As the global economy rattled, causing investors unmatched losses as forex, foreign exchange, and cryptocurrency markets, which trade around the clock, were the first casualties of the invasion. Joining me live via Zoom to evaluate the impact of the ongoing Russian-Ukraine crisis, of course, on the global and commodities market. I introduced him earlier. He's the head of retail investment at Chapel Hill, Denham, Mr. Ayodeji Ebo. Good afternoon. It's good to see you.
Good afternoon, sir. Thanks for having me.
Yes, there are lots of developments already globally, from the planned hike of interest rates, the COVID variants that we're still trying to grapple with, and now it's the Russian and Ukraine crisis. I know you can, let's start with you just giving an overview of what's been happening and what impacts you think this could have generally before we now start to break it down with looking at what investors will be looking at this time.
Okay, thanks. I think since the debacle started between Russia and Ukraine, we've seen the equities market on the global space dip further. We're all aware that the markets have just been trying to stabilize, has been faced with the issue, with the expectation of the U.S. Fed rates, and as well as rates across other developed markets. So equities markets has been suffering significant and downtrend. Beyond that, we also saw that since the war started, we've seen that a lot of investors are moving from equities now to the fixed income market, and we've seen a yield on fixed income yield on the fixed income market moderate. You see the U.S. Bond moderated by, I think, an average of about 0.2, or I'll say 25 bips within this period. Beyond that, there's also that psychology or that economic impact that it would have. You mentioned earlier that we expect, we've seen commodity prices increase significantly, which would impact on the purchasing power of the populace or the consumers, if I put it that way. For most of these developed countries, their market is well deregulated, that any increase in oil prices will impact on the cost of fuel, which would impact on cost of production. And because of even their weather, a lot of them also depend on gas. So we've seen that that volatility within the market and in terms of uncertainty around the economy, because the expectation is that if this is prolonged, when you look at a lot of the sanctions that is currently being placed, would also impact on the Euro economy, would impact not just Russia economy that will be impacted. It would impact on them, and that may even lower the growth expectation that we all had or has been projected for 2022. So by and large, it's really a volatile period, and for the market, investors will need to understand the market before they take any position this period.
Great stuff there, Ayo. Even in the news today, we also see that this would affect supply of refined products because these two countries are also players in the industry, looking at the delay that could happen, talking about the moving from cargoes from those countries down to Nigeria. Well, that's on one side. And on the other side, what now do you think investors should look at times like this, when we have situations like this? Volatility remains very high. Issues will happen around currencies too, one way or the other. This would affect the US dollar and of course other currencies. What particular things should investors be looking at this time to shape their decisions?
Okay, thanks. I think the first thing that investors should know that that the economy is a cycle, and every market downturn will always reverse. So if you have that proper understanding, when there's volatility, it is not the period to quickly sell and exit the market. It's a period that you try to invest in stocks with that long-term objective, because most of the stocks will come back to surpass their past all-time high, depending on the performance of the company. But we've seen that over time. If you do a chart of the S&P 500 for the last 30-40 years, you would see that after every crisis, markets rebound beyond the previous level. So what I would advise for equity investors is for them to think long-term. This is the time to begin to acquire stocks that have strong fundamentals, and you know that as the economy stabilizes, as the war between Russia and Ukraine also settles, we would see that these companies will bounce back and investors will come back into this market, which will lead to higher prices of the asset. Beyond that, it's also good that investors understand that they buy in tranches. Don't, because prices are cheap now, doesn't mean you put in all your funds. You need to split your funds into several parts, and over time, you continue to invest, which we call dollar cost averaging. It's important to also note that, so that you're able to average your cost of purchase over a period. And it's also a time that you may also want to rotate in terms of, we'll call it sector rotation. If you feel that if you look at sectors that has potential after all these prices are gone, those sectors that have the potential, it's the time to begin to invest in them. And for some sectors that might have given you enough return in the past, but because of these current crisis and they don't also have much potential, you move your money from those sectors to those new sectors. And that's speaking more to the global space. And looking at our own coming home, you would, because of the reduction of the participation of foreign investors, over 80% of activities are carried out by local investors. And that's why we've not seen that significant impact. If it were to be the past, like 2-3 years ago, we would have seen significant sell-off in our markets. But most of the activities are currently being carried out by domestic investors, even in the bonds market. So we're not seeing that much of sell-off. So what we would see is that we still have the issue of the expected hike in interest rates, though most investors, based on expectation, is that the US Fed come March 16 will increase interest rate by about 25 basis points. And so depending on how we feel that will still hold, but in terms of the aggressiveness of the frequency may taper depending on how the current situation goes.
Interesting stuff. And staying with the Fed's plan, if that happens, some say it could also affect Nigeria negatively, particularly in servicing debt and all of that. Do you think along that line?
So I think for us in Nigeria, most of our dollar funds would just be impacted when there's a devaluation. So the expected hike in interest rates would only impact the inflows that we may get. So we may see further delays, because we will need to pay significant premium before we can attract we can attract foreign portfolio investors to our country. We know they've thinned out over the last 2 years, but for us to attract them, we will need to raise our interest rates. But the CBN is not keen to doing that now because uh, the first step is to also see how you want to retain. But because a lot of them already exited the country even before this current situation, so the CBN is not really threatened by any major for any major exit that may occur. So we don't expect to see any major increase in interest rate for now. So, but by and large, I believe that what we would see is that there will be reduced investment across emerging markets. So when I say investment, foreign portfolio investors investing across emerging markets because their own instrument will become more attractive, and they will prefer to stick with theirs, depending on the interest rate and rating of other emerging markets as at now.
Price of crude is also above $100. Well, Brent is above $100, and this is also a fallout of this development. Now, what do you think? Russia and Ukraine are major producers of both energy and grains, and of course other commodities. What's your reaction to the price of crude? It's not really all well for Nigeria, where some countries are rejoicing with regards to this.
Okay, thanks. It's really a concerning situation for us because we should be smiling and rejoicing now. Yes, not like in terms of supporting the war, but in terms of smiling to the bank. Our production is really very low. And when you see the gap is still close to about 400,000 barrels per day, that we are the shortage that we still have for us to even benefit from these higher oil prices. When you look at the 2022 budget, projection for oil revenue is around 3.3 trillion naira. And the sad thing is that the downstream sector is not deregulated. So it means that government is paying more subsidy. The president was just planning to send for a supplementary budget for about 2.8 trillion for petrol subsidy. Now, with the current hike in oil prices or rising global oil prices, subsidy may be close to 4.5 to 5 trillion, which is significant. If our total projected revenue is about 8 trillion and our projected subsidy for the year is about 5 trillion, we can see that there's really a major problem. And I just feel that the current scarcity that we're seeing is also not a pointer for that government wants to find a way around increasing fuel. I think government lost the time to have increased it. And even if they have to do now, it has to be phased. It has to be gradual. And because we are also losing as Nigerians, because the current structure now is that it's taken from the proceeds. So if we are not producing more and to benefit from what we should be getting, and we are paying more for the refined products, it's really a major problem or a major concern. And speaking to the importation of wheat, when you look at the last 9 months, or the first 9 months rather, in 2021, we imported about 898 billion naira worth of wheat from Russia. So you see that they are the major key player. And when you look at the inputs that wheat serves, bread, a lot of Nigerians across, whether low, high income earners, consume bread. You look at wheat pasta, you would see that this is going to lead to increase in the prices of this item, which will further impact on the struggling pockets of Nigerians. So it's not really an interesting time for Nigeria, that we are just recovering from COVID, and there's also a lot of uncertainty within this period as we even prepare for the 2023 election. So in terms of investment or foreign investors' perception, they would perceive us as high risk due to the uncertainty. It's only when we've been elected and we've seen the new president understand his policy before a lot of investment will begin to flow into the country. So it's not really an interesting time for Nigeria now, but we feel that government needs to act fast in terms of how to increase production so that we can also benefit from these high crude oil prices.
Great stuff, Mr. Ayo. Before I let you go, let's touch on sanctions now, the financial sanctions made against Russia. What do you think about it? Some are saying it's just to impoverish the country for in long term, no effect. What do you think about the sanctions?
Okay, I think the sanction, I would say, is also necessary rather than going all out for war, fiscal war. So I think what they're trying to do is to see how they can reduce the influence of the country. But what we would see, like one of the ministers in the Euro area said that it's also going to affect these countries. So imagine they plan to take off, isolate Russia from the SWIFT network that process transactions for close to over 11,000 banks across Europe area. So it means that even for the countries that have been transacting, doing business and expecting inflow from Russia, they won't be able to get those inflows again. So it will impact on them. So if they also if Russia supplies gas, how will these countries also pay for the gas that they are supplying? And a lot of countries depend solely. When you look at the percentage, I think about 30% of total transaction within the EU area is consummated with Russia. And in terms of exportation of gas, about 70% is exported to the Euro area. So there's a lot of dependence on Russia, and they know that they play a major strategic role. So even those sanctions would impact significantly on other countries, and it may also crumble a lot of the economies of those other countries. But like someone said, there's also a price for peace. So there's a need to go through this, and it may get worse, but at the end of the day, we'll also get better. That's what I think.
It's a good way to live it. I've been speaking to the head of retail investments at Chapel Hill, Denham, Mr. Ayodeji Abo. Thank you so much for spending your afternoon with us this Monday. We appreciate this. To enjoy the rest of your day.
Pleasure.